People all over the world are finding it hard to buy basic foodstuffs, so high are global food prices. Many have taken to the streets demanding action from their governments. The World Bank says high food prices threaten social stability. What's fueling the increases and how far are speculators to blame? My guests today on Hard Talk are Terry Duffy, the head of the world's largest derivatives exchange, and Olivier De Schutter, UN Special Rapporteur on the right to food. Olivier De Schutter and Terry Duffy in Chicago, welcome to Hard Talk. Olivier De Schutter, the price of food staples like wheat and sugar go up, they go down, they're high now, but why should we be worried?
Well, the situation is a very worrying one. The price of wheat, for example, has increased 65% over the past 12 months. The price of corn has increased 79%. And for many food importing countries, which have very few budget possibilities to mitigate the impacts on their populations, it is a very serious problem. In many developing countries, the households spend 70–80% of their budgets on buying food, and when the local prices go up, and they are very closely correlated with the global prices, it is a very serious problem for those populations.
Terry Duffy, through your trading facilities, you bring together buyers and sellers in commodities. How aware are people like you about the social impact of high commodity prices?
Well, I think we're keenly aware of it, but at the same time, what we do here at the CME Group is we are basically a neutral facilitator of risk. So whether the price goes up or the price goes down, that's not for us to make a decision on. We are here to help people manage those risks. So that is people in the farming industry, the processing industry, and all other types of the food chain to come here to the CMEs to help mitigate those risks. So in return, they can produce that product and take some of the risk out of it, which they can pass some of those cost savings on to the consumer. I think that's a vitally important part of what we do. If these markets weren't here, the bid offer on products would get much, much wider, the cost of doing business would go up, and the risk would all be borne by the people who make the product. So if they don't have a place to lay off risk, the price goes up inherently, and that gets passed to the consumer. So I think what we do here is very important for the stability of food prices.
Olivier De Schutter, I mean, when you look at the whole area, there are producers, there are consumers, and actually high food prices do benefit some producers, many of them in poorer countries or big developing nations like Brazil, where the high prices may actually benefit them.
Well, I think that's a very bold jump to make. The reality is that many poor farmers benefit very little from higher prices. The reason is that they are not able to bargain for high prices from the local middleman who buys the crops from them. And when the prices go up on the international markets, they usually do not see a very significant...
But big agricultural producers, I mean, Terry Duffy has just set the scene that there are producers also, and, he's helping all sorts of people to manage risks. The big countries like Brazil, for instance, I mean, this is going to improve the state coffers, isn't it, for those poorer people?
Well, very clearly, some countries who are net food exporters will benefit from higher prices and their export revenues will increase. But for many poor, low-income countries in the developing world, particularly in sub-Saharan Africa, these are countries who are food importing countries. They've not invested enough in agriculture over the past years, and their food bills will climb very significantly as a result of this increase in prices. Many of them are actually not producing food enough for themselves, and they are depending on the international markets to feed themselves. And for these countries, what we are seeing is a very real disaster.
Okay. Terry Duffy, in your view, is food a tradable commodity just like any other, like gold, diamonds, for instance?
Well, without question, it's a tradable commodity, and people around the world want access to this asset class in their portfolios. And I think what's really important to note that they're going to get this, whether you and I like it or not, they're going to get access to this asset class to manage their portfolios, to balance their portfolios. It's all part of it. So if we don't give them a market like CME does to provide a futures market, you know, the real risk here is that people go out and actually buy the physical products themselves and take them off the market. Then you can see what it could really do to the prices. So, you know, there's a lot of investment dollars out there that can do different things. You want them to have them on regulated exchanges, and you want them to be able to participate under the rules of the U.S. and other jurisdictions. So the last thing you would want to do is take the participants out of the listed marketplace and actually put them into the physical commodity itself.
All right. Well, do you respond to that?
I think that what we have to understand here is that the markets have developed since 10 years in a way that makes them very difficult to read for those trading commodities on the physical markets. In 2000, about 20% only of those trading derivatives, which are the rights to buy or to sell in advance at predefined prices, only 20% were financial speculators. Now there are 80%. These markets have now taken such a direction that they have become purely speculative in nature, and they are sending very mixed signals to the traders, making volatility worse.
But that works in everything. It works in everything. I mean, the key point, and I will come on to the role of the speculators, Olivier De Schutter, but why should we treat food any differently from other tradable commodities? I mean, Terry Duffy said there quite clearly, of course, foodstuffs are tradable commodities.
Well, agricultural commodities are volatile by nature because it depends on the weather, because there are many, there's a big difficulty to respond to price signals for the producers, and demand is relatively not responsive to prices. So there is volatility in these markets. Now, volatility is increased over the past years, and there are very clear studies showing how volatility has increased, in large part because lots of money has been poured into agricultural commodities by non-specialists of those commodities. People who do not look at the curves of demand and supply, do not reason on the basis of stocks existing. They only have this herding behavior where they follow a bandwagon and they create bubbles.
So they're the ones who are creating the price. So what's the charge you're putting to somebody like Terry Duffy? Put it to him.
Well, I think the serious problem is with the commodity index funds which have developed since the deregulation of the early 2000s, 10 years ago, which have allowed commodity index funds to develop and to enter into these markets without being specialists of these markets. And they make their decisions on the basis of purely financial considerations, speculating.
So, all right, to put it in simple language then, you're basically, your charge is people are making money out of basic foodstuffs and adding to the price volatility.
That is very clear.
Terry Duffy?
Well, Olivier, you mentioned index funds, which I think is quite interesting because if you are a student of the markets, which I believe you are, you understand that the price discovery function of any particular market that's tradable happens during the last 30 days of the delivery period of that product. So index funds, even though if they're an increase in the marketplace, have absolutely no impact on the price of that product because they are long gone from that 30-day period where the price discovery is happening in the wheat, corn, soybeans, and any other product. The price discovery happens as you get convergence from futures to the actual cash market.
You need to keep that in simple language.
Those index participants are long gone.
Right. Terry Duffy, you need to just respond to that in pretty simple language. What do you say to the charge that basically speculators are adding to the price volatility and high prices that we're seeing in basic foodstuffs at the moment?
There's not an academic study, there's not a government study that has supported that evidence to say that that is true.
Olivier?
That's about as plain as I can say it.
There are actually many studies, and people like George Soros or Nourel Roubini from New York University are very clear about this issue. I think that what has been the problem? The problem has been that the markets where these derivatives are being traded are actually sending signals to the physical markets, those traders on the physical markets, which are becoming impossible to read. And the way traders work is they look at what these speculators are anticipating. And if these speculators are forming a bubble, then the traders will delay the sales, they will accelerate the buys, and there will be an artificial scarcity being created simply as a result of this financial phenomenon.
Terry Duffy, so there you are, he's citing the evidence there, and Olivier De Schutter is somebody who advises governments inside the United Nations about how best countries can feed their populations.
Okay, I'll go back to my original statement. George Soros is not a government official, and he's not an academic study that is suggested that his evidence is proven out to be true. It's not true. And the real fundamental facts here, Olivier, are that the government stocks in grains are low. There is a bigger appetite around the world for this product. The demand has increased tenfold over the last couple of years. You have countries that are becoming more industrialized, that are having a larger appetite for different food products, and that's exactly what we're seeing. We're seeing the growth throughout India, China, and others that are having a bigger demand for wheat, soybeans, and other grain products that they did not have 10 years ago. And you also have to realize that this is a perishable product. When you put it into the ground, a lot of things can go wrong. And if you don't get the crop yields that you would anticipate due to weather or other natural disasters, you are going to have a low supply. And when you have a low supply and a high demand for any product, the price will go up. Right, that is simple economics.
Olivier,
I think I'm not challenging the fact that there are real reasons behind the price spikes we are seeing. The reality is that speculators increase this volatility and make it worse. It's a bit like, pyromaniacs have not created fire, but still they spread it. And I think the volatility is made much worse because people speculate on future rises, and this develops into a self-fulfilling prophecy. It results in price increases because the traders see that there are these bets out there, and therefore they delay the sales, they stock food stocks, and they require higher prices. And so it becomes a self-fulfilling prophecy,
so
and
Terry
that has been a
Duffy,
problem.
I mean, Olivier De Schutter has conceded there that there are other causes, climatic causes, higher demand. People talk about agricultural land being used for biofuels rather than food production. So he accepts there are other factors that are increasing prices at the moment, but he says the speculators have a part to play. The question I want to ask you, Terry Duffy, is this. Are you saying that speculators have no part to play at all in these high prices?
I'm a believer that in order to have an efficient marketplace, you have to have a natural buyer, a natural seller, and then you have to have speculators in the market, and there's a whole host of participants that have to be in there to make it successful. Olivier, if we just had a handful of participants in the market, I will show you real volatility. What eliminates volatility is more people in the market, not less. And when you're suggesting that the market of speculators went from 20% to 60% in some of these products, that's what increased the volatility. If you had 20% of the participants in the market and you had what's going on in the world today, the volatility would be 10 times what it is today without those participants.
All right, but I want to ask you, Terry, though, are you saying speculators have no role to play at all in high food prices that we're seeing at the moment?
I am saying there's no evidence to suggest that speculators have a role in any particular price of any particular product. Right. When speculators get into a market, they may have a short-term impact, and I will not deny that. But they have a short-term impact if they all go out and buy 20 cars from a car dealership at one time also. So they have a near-term impact. But fundamentals is my point. They always win out. And these speculators, as we're suggesting, that are causing high food prices, they're out of the market before the price discovery function happens.
What about this short-term impact? Is that what you're objecting to? Because Terry Duffy says, OK, in the short term, they do have an impact. Is that what you're worried about?
The short term is what matters for people who, depend on access to food for their livelihoods. And in the short term, it has a very significant impact.
Terry Duffy?
If you look at the curves,
no, that's not true.
If you look at
you just said, Terry Duffy, you said the short term. In the short term, they have an impact. You accepted that.
If you have a group of people buying or selling any particular product around the world at the same time, they will have a price impact. There is no question about it, and that goes for listed products and products that don't even trade. They will have a short-term impact. My point is the fundamentals will come right back into play long before the price discovery is set that could have an impact to the end user or the people in these other countries that don't have the same food supply that developing nations have.
Okay, Olivier De Schutter, question to you is this. In September 2010, you wrote a report about the food riots and the high prices we saw in 2007, 2008, and you said a significant portion of the increase in volatility of essential food commodities can only be explained by the emergence of speculative behaviour, the speculative bubble. What is the portion you're talking about? Do you know?
Well, it's very difficult and it depends on each commodity.
10%, 20%, 50, 60?
It is certainly 30, 40% for wheat and corn, for example. It is much less for other commodities, and it depends where these commodity index funds put their money in.
And you think it's the same thing now? It's the same thing going on now?
It's the same thing going on. If you look at the price curves, this cannot be explained by the fundamentals of China and India eating more. That simply is not driven by these forces primarily.
All right, Terry Duffy, I mean, Michel, you said there are no academic studies, but Michel Barnier, the European Union Internal Markets Commissioner, somebody very, very senior, of course, says, I find speculation in agricultural commodities where it exists to be scandalous. There clearly is a whole body of opinion, powerful officials also who are clamouring for action. You've got anti-poverty campaigners like the World Development Movement. Its director calling for action against financial institutions in the city of London that play with the lives of millions around the world, causing havoc with the prices we all pay for basic foods. So there is this body of opinion. It's inevitable that something's got to be done. Do you accept that, Terry Duffy?
No, I don't accept that because I think that that's wrong thinking. I mean, how do you explain the same percentage increases in products that have absolutely no futures market in them and absolutely no speculators in them because they don't trade? So how do you explain the percentage gains in those products that also are a food staple for around the world? So I don't subscribe to that. And
but
when
action
you say
is inevitable. Action's going to be inevitable.
But Olivier,
don't you think actions now are going to be inevitable?
I just want to go back to what actions are going to be inevitable.
Do you not think that there's going to be, I mean, there are calls for regulation?
Well, I think that, you know, right now in the United States, we passed Dodd-Frank, as you are all well aware. And in Dodd-Frank, in the Title VII of the derivatives section, it says that the Commodity Futures Trading Commission shall have the ability, if there's a finding, to institute position limits on certain products if they have a finding. So we've passed a law in this country that already gives the ability to our regulators that if they see excessive speculation, that they have the ability to rein it in.
And
so
in fact,
we have
they've done
that ability
that.
in this country today.
So Olivier De Schutter, I mean, that's a case in point. Through that act, you've got regulation in the United States. 2008, a total of $2 million in fines was imposed on US future rice speculators. So do we need anything more to be done?
Well, the CFTC, which is the regulatory authority in the US working on implementing the Dodd-Frank Act, is still looking at how to implement it better. And a very powerful lobbying is going on there, as well as in the EU, about how to regulate these markets. I think regulation is indeed unavoidable. We need to make a clear distinction between the commercial traders who are actually hedging against risk by exchanging derivatives and buying futures and so on, and the purely financial speculators whose role has been very destabilizing for the markets and whose role has increased significantly over the past 10 years. And those, I believe, should be prohibited from trading in the commodities markets because these are being destabilized beyond proportion.
Terry Duffy, you're smiling there.
I am. I got to comment on that because I think if you talk to the big producers of grains in the world and you told them that we're going to eliminate a big part of the other side of the transaction for them, which is the speculator, so good luck to you about managing your risks, they'd have a little different opinion than you do, Olivier, about what the price of that product would cost you and me and the next guy. You need to have all these people in the marketplace.
I disagree with this. If you read the recent statements by the Unilever boss, for example, Polman, he is in favor of removing speculators from markets. And things worked perfectly well before 2000, before these markets were deregulated and before the commodity index funds could develop as they have. And the difference between then and now is now we have new actors who make their decisions based on purely portfolio considerations and are completely uninterested in the fundamentals of the market. So they do not function as price discovery mechanisms. They simply set the prices for the market on the basis of purely financial considerations linked to basically hedging risk against petrol, minerals, and food commodities.
Olivier, answer me the question how these index funds that you're referring to, who are setting the price of the market, who are not even involved in the market, when the market comes to the price discovery function at expiration, they're nowhere to be found. Right. They're not in the market.
You made that point earlier on.
Every evidence in the world that says it. I want to make it again. How can you say they're affecting price?
Okay, well, you're going through the arguments again.
On 16 December on CNBC,
very quickly.
Terry, you said the US should not abandon its ability to discover the prices for the world. And you said we should not be price discovery importers. What you were saying there is that speculators are setting the prices for the world, and what you call price discovery is, in fact, deciding what the traders should pay.
Olivier De Schutter, I want to ask you, at the end of the day, you can't really blame traders, can you, for high food prices? As I said at the beginning, prices go up, they go down. Surely it's up to governments to ensure that their own people have a right to food. You're a human rights lawyer. The right to food is a basic right, but it's not for traders to sort that out. They're there, they're doing their business. It's for governments. Leaders, after all, in countries never go hungry. So why blame these guys, the speculators, whatever? It's governments who have this responsibility.
Well, I think the unregulated nature of these markets is making it worse for many people around the world. And governments,
but it's for their governments to feed them.
Governments have a responsibility to regulate them, and certainly they should not only regulate those markets, they should also make decisions about investing in agriculture, about reducing the biofuels production, about strengthening farmers' ability to produce, and limiting volatility, which is a very strong disincentive for producers to produce. And so many things should be done by governments.
Many things should be done, but
beyond regulation.
Is it for traders, though, to concern themselves with what are basically moral issues?
I think what is rational for one trader to do may have huge social costs, and I believe traders should be aware that these are costs that they are imposing on society. And there are many traders who now are open about this and acknowledge the fact that they are having this impact on prices all over the world.
Olivier De Schutter and Terry Duffy in Chicago. Gentlemen, thank you both very much for coming on Hard Talk.